Okay, let's directly jump into the creation of a statement of cash flows. Once we create this balance sheet, budgeted balance sheet and income statement, always starting point is net income, and to reconcile and then convert into the cash of operation and investing and financing, and then we got the ending balance, right? And then comparing between the 2 month balances, we got increase or decrease, the changes in accounts receivable and inventory accounts payable on the balance sheet. Okay, here net income. Net income of February, and the depreciation should be positive. Why? Because we need to add back, right? And then change in accounts receivable. If it is increased, then right, it is minus. So we have to start from old and new, then 300, which is negative. Changes in inventory. Do we have changes in inventory? No, because we have the inventory policy. The beginning and ending balance are the same of 500 assumed. And the change in accounts payable. Do we have accounts payable if accounts payable increase? But no, because the business model is very simple. We pay our purchase right away when we purchase, right? And so the cash flow from operation is just the sum of this, and then 223 is cash flow from operation. Again, that minus is the bad signal, right? The one is single one, because the company want to create the operating cash. They might need some cash, the financing. And then here, the change in gross of fixed asset. The company never purchased any fixed asset, so there's no fixed asset. Cash flow from investing is still 0. New bank loans. New bank loans we calculate. As I mentioned earlier, again, the essential point, the starting point is the balance sheet in this the short-term planning model. We don't have cash schedules or cash budget as a starting point, but we started from this balance sheet, right? So new balance, new bank loans, the company now has, right, here you go, this minus this, always from the balance changes. The cash flow from financing is just only 1, right? And then net monthly cash flows, how to get it? We want to sum those 3 activities. And then net balance is the 30. And then beginning cash was 50. Then we got ending balance, which is required balance, 80, which is same, right? This is just the backward we got the calculation. And then let's drag just one by one. Let's just double check if we met the right amount. The 80, we have the 80, and then new balance, new bank balance, the difference between 2. Okay, good. So let's just drag to the right. Then we got the ending cash balance every month, which is the same, because the net monthly cash flow was 30. The beginning of cash balance, the ending balance of prior month was 50. So by creating the 30 more cash flow, and we got the ending required cash balance 80, which is the same as the ending balance of the balance sheet as well, right? So we got the right amount here. And then let's double check the bank loans. How much we need the bank loans from the balance sheet. Again, here bank loan increased. Minus. Let's just drag one more, and yeah, that is the right amount. Exactly same as the new bank loans here, right? And then cumulative bank loan amount. Cumulative amount should be also now the same as, right, this new bank loans amount. How to get it? So we start from here, and then let's just add new balance, new additional funding, right? And then we got this the cumulative bank loans, which is the same as here new bank loan amount here, right? This amount should be same as this cumulative amount as well. Then we checked. Okay, and then finally the cash budget. Cash budget, the total net, the monthly cash flows, and the ending cash flow before borrowing and the new bank loans, and then this ending cash should be matched. Here the collections. How do you get these collections? Okay, as we assume that 100% the credit sales is going to be collected next month. So the collection here, accounts receivable 700 prior month. Let's drag it to the right side. So we collected all the accounts receivable of the prior month. The purchase is, again, the ending and beginning are the same. The cost of goods sold is the purchase in this case. So the purchase is the cost of goods sold. And let's drag. And then operating cash from income statement. Operating cash from income statement. There we go, 70. And let's drag. So we collected all the operating, the expenses, and the payment of the interest. The payment of the interest from the income statement. There we go. Let's drag. So we collect all this. We linked this all the payment of the interest. The payment of tax, also the same way. And then investment of fixed asset. Do we have the investment of fixed asset? No, there's no fixed asset investment. So, there we go. Then net monthly cash flows is sum of all, and then we got it. The beginning cash amount is the ending balance of prior month. Ending balance of prior month is 50, right? And then when we drag it to the right, all the amount is from the prior month. The target cash amount the company set up was here, the required cash. Let's drag. And the ending cash balance. How to get this ending cash balance is net cash plus the beginning balance and required cash minus required cash. Let's drag. The new bank loan that we need is new bank loan. Where do we get this new bank loan? Okay, new bank loan. There you go. Then let's drag to the right. Then finally, ending required cash to double check is the target cash amount plus ending cash before borrowing and new bank loan. It must be 80, right? Finally, we create a cash budget. Again, this case is the short-term planning for the venture, the firm that has a very relatively new company that doesn't need to have that the schedules, because the cash transaction is almost the same as their business activities. Okay, in that case, in order to get the new bank loans, we need to start from just the financial statement, budgeted financial statement, and then we go to the cash budget in backward. Here in the surplus cash, if the total asset is greater than is total liability and equity is greater than total asset before getting this surplus cash, and then we have to add the surplus cash. There's no new debt loans, but in this case the company need the new bank loans as the normal the business of the venture firm has. Okay, this is it. See you in the next video clip, you guys. Bye bye.